So welcome, Stanley, welcome again, one more in our series of webinars.
Well, this is to me is almost a labor of love. I've been trying to evangelize, if you will, or to preach to the choir about the importance of internal controls for my entire career. And it doesn't seem to matter the size of an organization. Internal controls is essential for performing things properly and for preventing as much as possible dishonesty within an organization and dishonesty that could affect the organization's name. So these are the policies, procedures, and processes and systems that help an organization achieve its goals and mitigate its risks. And these controls are relevant to everyone in an organization and include a variety of activities. The goals there are really three main goals. It's effectiveness and efficiency of operations, reliability of financial reporting, and compliance with relevant laws and regulations. The three main types of controls, or internal controls, are preventive, detective, and corrective. Preventive controls are designed to prevent or minimize the possibility of mistakes or inappropriate conduct before such conduct occurs. Detective controls are the controls that are used to identify errors or inappropriate conduct after those things have occurred and been discovered. This is the forensic part of the control work. This is the after the fact sort of work.
And it's interesting that you mentioned those three types of controls, because there is a case that was just announced last week against none other than our good friend Wells Fargo, who has been, they had a sterling reputation for so long. They were like the best run bank in the world until we started finding out what was going on inside. But last Thursday, the Office of the Comptroller of the Currency just announced another case against Wells Fargo for, guess what? Missing internal controls. But given how much they've been in the news over the past few years, it would seem that they missed out on one of the more important, as you were talking about, the corrective controls. Because if they're still having problems with their internal controls, then they did not obviously implement sufficient corrective controls after the other failures were identified. Because some of the issues that came up are really similar to things that came before, such as misapplying loan payments, wrongfully foreclosing on homes, illegally repossessing vehicles. I mean, things that were using their, working against their clients' interests, just as they had been in the prior cases. So let's talk a little bit more about how these three different areas of controls work together.
So let's talk about the corrective. So the corrective controls, since you mentioned them, those are the controls that are designed after the fact to remediate prior control failures and prevent similar failures from recurring. So if we talk about the preventive controls to begin with, there is a mountain of information published about preventive internal controls. And one of the reasons these things occur is that there is a focus on sales, on income, on bringing in revenues that becomes obsessively dangerous for the people in certain positions. They're so obsessed with making income occur that they take their eye off the ball of controls and consequences that are supposed to be part of the controls when there's a failure. And so I think that, and then when that happens, they call people like myself in to do a complete study of what happened and to find out where all the money went or where all the failures were. But it always involves a lack of supervision and a lack of complete understanding or full understanding of what these controls are supposed to do and how they're designed. So let's talk about preventive controls. So the most important one is probably segregation of duties, because by segregation of duties, the simplest example, and this is designed to prevent mistakes or inappropriate conduct before it occurs, is requiring that two signatures be on a check. If a check is written, or that it requires or that it requires an appropriate approval before an electronic payment is made. An approval by somebody above the person who is calling for the payment. And that means a coordination between the organization, if it happens to be a private entity, and its own bank. Okay, it's very important. Segregation of duties is important, and it means that the same person, for example, can't issue invoices and then receive the money and then deposit the money in the bank. And that same person can't also issue payments, because that is placing too much risk into the hands of one person, and human beings are known to be somewhat susceptible to making these kinds of mistakes. And one of the reasons they make these kinds of mistakes, and this goes to the whole concept of corporate governance, is if an employee knows or has reason to know that their boss or the owner of their company is committing acts which are not completely clean or they're not completely legal, they may take the position, and this has been known to happen in cases, that, well, my boss is doing it, why can't I do it? I'll do it my own way.
Well, and that's something we used to see a lot in the world of private banking that I was in. When you have a top producer who's given wider leeway in terms of regulations, it creates a sense among everyone else that, well, if he can get away with it, why shouldn't I be able to? And so it corrodes the sense of the rules apply to everyone.
Well, it does, and one of the other areas of friction I used to run into when I used to work with these banks is that there would be a constant sense of friction between the retail side of the bank and the wholesale side of the bank. That is and so lenders want to make loans, and compliance people want to say, wait a minute, hold it, let's look at this a little more closely. And that's why you have to have controls and you have to have levels of authority.
Well, I'm going to throw something out that we hadn't talked about before, but you might have a comment on this. How do you control for collusion? So segregation of duties works really well as long as there's no collusion. But are there any things that institutions can do to prevent collusion among employees?
Yes, that goes back to the internal audit function of a company. It also it also goes to the outside auditors a little bit. It depends on what their relationships are. But certainly the internal audit department of a company or of a bank has a really, really large responsibility and a very important responsibility to detect where possible collusion is occurring. When there's collusion between an outsider and collusion with an insider of a bank, that can lead to other problems. Right now, we are doing an embezzlement investigation, and this is not the first one we've done on behalf of a private company. But in the earlier ones, we found that there were employees, and we're going to find that in this case also, because of the amount of money involved, that there was an employee at a bank who was assisting the controller of a company to steal money from the company where this controller worked by permitting the opening of certain accounts, which had names similar to but weren't exactly the same as the company for which this person worked. And so a lot of money went funneled out through the collection of accounts receivable and effectively the lapping, what's called lapping of payments. So the payments would be moving. Eventually they'd get to the right account, but in the meantime, they'd take money from company A and apply it backwards to company B because company B's payment had already been stolen. Okay. So these things occur. And so, yes, there has to be internal audit controls. They are important. And the outside auditors are supposed to work with something called professional skepticism, at least in the United States. It's one of the American Institute of CPA's very important controls on audits. And so professional skepticism basically is saying, hey, take the position that something can occur. Don't just don't accept people's word for what's happening. Do your analysis to determine, for example, if a payment for company A somehow went to cover up something that occurred with company D's payments. This applies to banks in the same way. When money's flowing through the bank from a particular customer, make sure that the amounts of money that are flowing into the bank from that customer are within the historical pattern of that customer, that it fits their template, their pattern, because, or their exactly what they've set up with the bank. What are you doing as a customer? When I started to work internationally, I went back to my bank and I said, listen, I'm changing my profile. Well, how are you changing your profile? I'm changing my profile to let you know that I will be receiving overseas wire transfers into my business accounts, because I am now consulting for foreign banks and foreign entities, and they will be paying me with wire transfers. Most of my colleagues don't have wire transfers coming in from outside the United States. And so in order to prevent OFAC and other alerts, the bank had to be able to be satisfied and comfortable with what I was doing. And that was an internal control issue for the bank, because the controller of the currency might have come back and said, what is this guy Foodman doing? And
Well, no,
didn't
that goes into some of the detective controls that we're going to talk about, I think, in a few
but
minutes.
that's after the fact.
In terms of preventing collusion, I guess you would really need to do things like not allow husband and wife to work together, or family members.
Okay.
Or,
It depends on the size of the organization, Isabel.
Obviously, it depends
Okay,
on the size.
so in very large companies, there's usually some kind of, and I say large, I mean public companies, or
Right.
something approaching a public company. There's usually some kind of controls on family members working in the company. Now, it becomes more difficult, for example, in a large private company, when they're going to pass the company on to their children. But
Well,
certainly,
that's different when it's part of management, I think.
but certainly when it's access to the funds and the assets of the company, it becomes a real issue. It
Right.
can become a real issue. So yes, I think that those are part of the controls. There are physical controls. I used to be part of the independent audit committee of one of the municipalities in South Florida. It's the largest independent municipality. And one of the things we found was that there were not enough controls on the assets. It was not impossible, virtually impossible, for people to sell a company asset and get away with it, and be able to do it, because there were no controls on these assets. So what are some of those controls? Well, you secure physical assets by creating serial numbers for all of them, which are then maintained by the company. And in order to remove those serial numbers and those plates, it has to damage the asset, so it can't be easily removed. Things like that. And that's the same thing of equipment. Inventories is another big problem. Inventory tends to grow legs and walk away. It tends to become easy to move, especially if it's a small but valuable piece of inventory. And of course, in the precious metals industry, it is a huge, it's a huge need to have internal controls over what's happening to the inventory that they have. And I'm going to let you talk about the securities side of it. How do we control the securities, and what are the physical controls on securities?
Well, I mean, today almost all securities are electronic, so it's not like you have to, secure stock certificates or anything like that. But one area where we've always seen issues is in how do you control customer credit cards and debit cards that you have pending to give them. And so making sure you have strict controls over who has access to that type of thing, who can create a debit to a customer's account, who can access their credit cards and debit cards, and how do you control cash, and how do you make sure that tellers are appropriately being controlled in terms of how their cash goes in and out. So those are things that I think the cash part is pretty well controlled, but I think the customer credit cards, I've seen that there's still in many cases, a vault where kind
of. Okay, I'm back.
So, but you were talking about things like credit cards. I will tell you that in the telecommunications industry, one of the controls that was hard to maintain, because of the way in which telecommunications cards were distributed, were the cards that were being sold, the phone cards, out of things like supermarkets and out of these quick marts, these gasoline stations, these gasolineros, right? So they were used also for other purposes, but there was no control on them. There was no control on those cards. So a lot of those cards were being used by bad actors to create money laundering assets by depositing their money in those cards. And
Well,
later,
that brings us to prepaid cards as well. Then those have to be controlled not only in financial institutions, but a lot of stores now sell prepaid cards, so they'll need to make sure they have good controls on those as well.
absolutely. And then we get to cybersecurity, which is the big bad wolf, right? So we're all suffering worldwide from hackers and folks who are stealing very sensitive data and using it to rob other people, third parties, by creating transactions that don't exist for those parties, but in the name of those parties. So those parties all end up in all kinds of legal problems or have to hire attorneys to resolve their own credit issues. Firewalls can be penetrated. We've seen that in the case of the biggest companies. Microsoft has had problems, for example. All of the large players in the IT industry have been penetrated at one time or another and been hacked. And these things need constant updating and constant review. And then there's the physical barriers, which I discussed. I discussed one kind, which was to control physical inventories. We have PIN numbers, we have systems access, we have safeguarding passwords. At the present time, we probably, and of course now it's gotten to the point where every 45 days, some companies with whom who supply IT programs, right? They're requesting that the passwords be changed every 45 days, and a lot of companies, most companies that I'm working with, at least, are requiring multi-factor or at minimum dual-factor authentication, because it turns out that the cell phones may be more secure than any other method for getting this information. But even those have been penetrated. So
Well, and the problem with forcing you to change your PIN number every 45 days is then you end up with all your employees have their passwords scribbled on note cards on their desks, and that's, a little bit risky. So I don't know that this is something everyone I think on this call will have already seen, that the IRS has now changed how you can access your FATCA portals, and it's now requiring everyone to go through the secure login.gov or ID.me, and they require you to use an authenticator in order to
that's right.
validate your access. And so, the idea of using authenticators, I think, is going to grow because nobody can manage all of the passwords that we have for all the different
Well,
things.
no, it's virtually impossible. And I know that right now, the software that I use, and you could be using Google Chrome, Microsoft Edge, they all have a facility, they all have a tool built in to say, would you like us to manage your passwords? Because we really recognize you can't remember all of it, but we can remember it for you. And so the question is, how much faith does one have in these systems to be safe, especially when they've all been penetrated? So Isabel, why don't we talk about some of these things that can be done, such as performance reviews and other things?
Well, now we're starting to get into the detective controls. So institutions have to set up preventive mechanisms, but then they have to have a way of detecting. And you were alluding to this earlier. One of the most important ways is, well, the industry calls them performance reviews, but really what it is taking measures to compare actual activity with expected activity. In banks, they do transaction monitoring more to detect money laundering activity on the part of customers, but you should apply that as well to pretty much every area of activity. If you have one employee who has way more sales than anyone else, maybe he's just a really good salesman, he or she, but maybe there's something going on there that needs to be looked at. So making sure that you have, KPIs, key performance indicators, and then methods of validating them to make sure that what you're getting is what you expect. And if it's not, then you need to be able to have a look into why. And again, in many cases, it's just because, people do not perform at the same level. You have different levels of performance, and sometimes you need both the tortoise and the hare, right? But in addition to performance reviews, you need to make sure that you have reconciliations of those mechanisms. So make sure, for example, when you do transaction monitoring, make sure that you're reconciling that every transaction that went into the banking core, the core banking system, is also being captured by your transaction monitoring. Make sure that you're reconciling the number of loans that are put out, like Wells Fargo clearly didn't do. Need to have quality assurance, not of every single transaction, but a bit random and sufficient to be able to capture any patterns that might be taking place.
And that's a function of the risk matrix that you choose to set up for your own organization.
Correct.
Because it's statistically, you have to determine what your appetite is for risk and then determine statistically how, or by basically by the gut feeling, what you want to do with respect to quality assurance. That's really something that I think is overlooked. We apply it in a lot of areas, but we don't necessarily apply it internally by organizations for themselves. They apply it to other things. What you're recommending and what we're both recommending is that they apply it in every department for whatever function they have throughout the organization, depending on their risk appetite.
Well, and not just depending on their risk appetite, but also taking a risk-based approach. High-risk customers, high-risk departments, high-risk products would have a higher level of quality assurance, for example, than lower-risk ones. So, making sure that you don't have to check everything all the time, but you need to do it on a risk-based approach.
And that risk-based approach is a matrix of some kind that you've set up.
Exactly.
For your own comfort, based on your risk, for your appetite for how much risk you want to take. And this is one of the areas of not of failing, but where banks and other organizations can get into some trouble with regulatory authorities, because while they require a risk-based approach, they don't actually tell anybody how to do it. They don't provide any safe harbors. They just say you're on your own, and if you get into trouble, we'll fine you, we'll take your money, whatever, but you're on your own, and hopefully we won't have a problem, but you might, and if you do, it's because it'll be your own fault.
Except, let's distinguish here, because the regulators are the fourth line of defense. We're going to be talking about that in the next section. But one of the things that I think we can pretty much agree on is that even if the individual regulators that come into your financial institution are, as they say, more Catholic than the Pope, and expect, when you talk about risk-based approach, they want you to, the risk-based approach is zero risk, right? But when you look at enforcement actions, the enforcement actions, and particularly large fines, have all been applied for really egregious behavior, usually starting with management. So even though, yes, your regulator is going to insist on an extremely high standard, the risk to the institution of fines or reputation really come down to, if you have a good, solid internal control structure and a good faith approach to compliance, the regulator, the enforcement people take that into account when they come to look at any problem that might arise.
And there's a good chance, I think, that these large fines will be the result of little or no action or no appropriate action taken after soft warnings are received.
Like Wells Fargo.
Of course, the U.S. IRS has decided, when they start a new program, they send out a series of warnings, and each warning becomes more dire over the period of time they've decided they're going to give the public to comply. And at the end of the day, then they come back with, and now you must do it this way, and if you don't, we're going to fine you. We might even criminally prosecute you. But you've had plenty of warnings over, for example, the last 5 years. From 2014 until 2021, we had nothing but soft warnings concerning digital currency, so-called bitcoins and cryptocurrency, for the reporting of transactions with them. And then one day they said, now you have to tell us that you're doing it. If you don't, you will have been filing a false return. And if we catch you filing that false return, we're going to prosecute you, either civilly or criminally or both. So yes, it's really important. This is and paying attention. When if you all have a FATCA program, as an example, what would be your internal controls on your FATCA program? One of the most important ones is to review your portal with regularity and respond to what's in the portal.
Exactly.
If it requires a response, and in a timely manner.
Exactly.
because all of these systems have become automated, and therefore, if you don't respond within the 30 days or whatever the number of days are that's in the notice, there you could actually have your portal frozen.
Or
So,
lose your gin, which we've
or
seen a
lose
number
your
of
chin,
people do that. Right.
whichever we've seen that happen. So I think that's a good example. I
Hey,
see.
one more detective control that I think is really important that people overlook, and that is having confidential reporting and tip lines. And the problem with those in most organizations is that people will not use them for fear of retaliation, or that their complaint will get public somehow, or that their boss or supervisor. So if you're going to have a tip line or confidential reporting, it's incumbent on management to ensure that there is a high level of confidentiality, and that the person who's receiving the information is sufficiently high in the organization to be able to ensure that no retaliation takes place. That's just a very important factor there I've seen.
Well, under certain U.S. federal laws and state laws in some states, whistleblowers or people who have these tip lines are sacrosanct. They cannot support, purportedly there can be no retaliation, and when there is, it creates problems for those that are retaliating. So there has to also be another level to prevent the retaliation, another level of control.
Right.
And then, of course, we have your requiring multiple levels of review, which we've already touched on.
Yeah.
So
And I think we've pretty much talked about corrective controls as well, the importance of following up. And I guess one of the most important corrective controls too is employee training, making sure people understand what went wrong, why, and how to do it differently. Internal investigations are important as well as disciplinary actions so that people don't feel like, people got away with stuff, that just breeds contempt, or what we call in English scofflaws, people who don't really follow the rules because they're not going to be enforced.
let's touch on backing up and restoring procedures for information systems. With ransomware attacks, folks that had not been backing up on a regular basis faced nightmares. How can they restore their system after it's been sanitized when they can't get to their information to begin with? So I think that's sometimes overlooked, and it's overlooked, and you do it at your own risk to overlook it, but they should be daily. Backups should be done daily. Should never have to, and off-site or in another location. You're not backing up to your own computer, but you're going to a separate physical structure to maintain the data, because backing up to your own system just means that ransomware is going to attack your backup also.
Right. And we're seeing more of it.
Oh yes. So the COSO framework, better known as the Committee of Sponsoring Organizations, this is a very big name, of the Treadway Commission Internal Control Integrated Framework, or ICIF. That's the organization that sets the standards. It's sort of like the American Institute of Architects sets the standards for accounting for construction in the United States, and everybody has to follow it. This particular organization, which is international, it's globally recognized, and it helps organizations design, implement, and assess internal controls. And it provides a roadmap. It provides a roadmap for achieving the safeguards, for achieving safeguards that allow objectives to be achieved by organizations. So this has been something that I've been focused on for a long time. I think it's one of the most important things, because what we're really talking about is how to prevent fraud, how to prevent embezzlement, how to prevent theft. And so for me, it has a special place in my practice. So originally it was issued in 1992. They refreshed it in 2013, and they have their own website, the COSO website, and they define it in COSO as a process, internal controls, effected by people, which is usually the board of directors, management, and certain other high-level personnel, which is designed to provide reasonable assurance about achieving objectives. This is a process, by the way. It's not the end in itself. It's relating to operations, reporting, and compliance, and it must be adaptable to the structure of an organization. So So when internal control processes are being designed, is it's important to consider how the components of the organization operate together. It's important to identify redundant or inefficient controls, which are minimal in value and reducing risk, simply because once they're done, or once something has occurred, or once the control is implemented, it's not necessary to necessarily have a redundant requirement that's very inefficient. It provides minimal reward for the amount of time and effort that's being exerted. And so how do they work together? Well, that means that nothing gets siloed. Nothing should be siloed. In other words, and that would mean that it's important to rotate people in organizations so that nobody necessarily accrues too much power and too much authority or too much effectiveness over other people in the organization on their own.
Well, and then you see that sometimes in organizations where, particularly say small to mid-sized ones, where somebody's been there so long that they're the only person who knows how a particular process is done. So everybody relies on that individual, and there's no shared institutional knowledge. And, this is one of the things we saw even with FATCA when a lot of people left or responsible officers left, they took their institutional knowledge with them.
Yes.
And so I think making sure that a variety of people know how to do the same thing is important as well.
So what we're talking about was what we used to call cross training.
Mm-hmm.
It's sort of like playing volleyball. If people move down the line moves back, it comes back around to the front, but people get processed through the organization. In the old line banks, everybody started off as a teller, as an example. And then when they had enough training as a teller and how that works, then they went to a different position and yet a different position. And some people never ended up in the loan department. Other people did. Some people went to IT. But in general, everybody was processed through the entire organization of the bank. So as you said, there's redundancy. And so that if somebody leaves, institutional knowledge isn't lost along the way.
Exactly. And that brings us to one of the basic concepts in COSO, and everybody on this call, I'm sure, is aware of it, was what we call the 3 lines of defense. And before this concept became prevalent, it was kind of the front line did whatever they wanted, and then it was up to compliance and risk management to control for that. But under the COSO framework, the 3 lines of defense, the very first line of defense is your operational management. And these are the frontline and midline managers who have the day-to-day ownership and management of the risk controls. They're the ones who are implementing the controls. They're the ones who have to make sure that it's done properly, and to ensure that the objectives of the organization are achieved. And it's really essential to have well-developed processes for the front lines and mechanisms to make sure that they're followed. And, we were talking about yesterday, one of the greatest fraud cases that we've seen in our lifetimes, maybe, which is the Madoff fraud, where Madoff was able to, billions of dollars worth of fraud committed against his own customers. And one of the interesting things that I heard during that time was from a fellow who was in an institution that had never sold Madoff to their customers, even though they were in private banking with Latin American customers and all the customers wanted it. And the comment he made was that in our organization, every new investment manager has to be approved by a committee. They have to meet certain criteria. They have to provide an investment advisory agreement. They have to provide a track record. They have to show us how their black boxes work, or at least give us an idea of how they work. There has to be replicable activity going on. And in Madoff, there was none of that. So the organizations that ended up selling Madoff, or individuals, was when one person would make the decision unilaterally for the organization, or individual investors who just wanted that access to what they saw as, something really special. And Madoff was really good at making it feel that his product was exclusive and that, you know, you could only get it if you let him do whatever he wanted to do. So I think in terms of preventing that type of risk from happening again, part of it is making sure that you have criteria and processes for new products, for new investment managers, for any new activity within the organization has to be vetted against some sort of objective standards rather than, oh, everyone else is doing it, so let's do it too. What was the famous line that the CEO of Citibank made at the time is when everybody else is dancing, you have to get up and dance as well. Well, look how that ended up for the world in the 2008 financial crisis, right?
Exactly, exactly. And, you know, when you mentioned Madoff, remember that Madoff was a power unto himself. His organization may have had certain internal controls for other people, but Madoff answered to no one. Everybody must be answerable to somebody. And there has to be consequences when things are uncovered. And the consequences may or may not be appropriate for a specific act. In other words, we have to make sure the consequences fit the act which causes the consequences to be triggered. Madoff was a very special case, and but he's not the only one. There's a case of a lawyer who became very, very large down in South Florida. And it was a Ponzi scheme ultimately, as was Madoff. But he was the same thing. He was a power unto himself within that law firm. He was the founder and he answered to no one. So when we talk about separation of duties, we talk about, at the beginning of this talk, we talked about separation of duties. We spoke about being answerable, having consequences. Without it, there is no internal control. When one person can do whatever they want, there is no internal. There's no real internal control. And any controls that are imposed from the top down at the whim of the person at the top, as opposed to having a set of written policies and procedures to which people have to adhere. So
I just want to mention that COSO also focuses on two items that we talked about before. One of them is the confidential reporting and incentives and disciplinary measures. So that's part of the framework. So, you know, if people are concerned about how they can justify it, that's the COSO framework includes that in terms of the front line and the first line of defense.
Okay, and what about the compliance incentives and the disciplinary measures?
Well, it's important, I think, that organizations need to include compliance as part of the objectives of their personnel. Salespeople should have not just a bottom line dollar sales metric, they should also have a compliance metric, and that should be part of their compensation. In fact, a couple of recent cases, and I don't remember which ones they were right now, but one of the things that they're talking about in a lot of the anti-money laundering, excuse me, is the need to make sure that people who don't comply have their pay docked, and that there's clawbacks even for boards of directors if they've received bonuses and later it turns out that their performance was based on some type of improper conduct. That, you know, there should be clawbacks for bonuses that are paid out on unethical behavior.
Such that everything isn't tied purely to revenue, but rather it's tied to the revenue plus the behavior that created the revenue.
Correct.
Okay. So the second line of defense for internal controls is internal monitoring and oversight functions. The internal monitoring is everybody has a boss, everybody has a supervisor, so to speak, and everybody below that supervisor is responsible to that supervisor, and it goes on up the line. But the oversight functions become broader and broader over time. So there has to be a reporting structure internally, and then there has to be internal monitoring and internal auditing of what's being reported. What this does is, what the second line of defense is it supports the senior management of an organization by bringing expertise and monitoring alongside the first line. Now, that expertise and monitoring could be from an internal audit department of some kind. It could also be from an outside group, as long as it's independent of that first line. Okay, very important to have independence. And with that, we have internal investigations. Right now, I'm essentially doing an internal investigation of, as I said earlier, of a large embezzlement, or defalco in Spanish. So it's $10 million. It's a lot of money. And it took 5 years to do it, but this person did it. But this person was never supervised. So what we're doing is we're investigating the violation to find out how bad it is exactly and how it was done, so that they can so they're putting in controls to avoid those problems again. And of course, the most important control was that person wasn't adequately supervised. And so these sorts of investigations should be supervised by an individual who's independent of your business or of your bank, or under the unit, or of the unit under investigation, with a direct reporting line to the board of directors. In our case, we're reporting to a law firm who's reporting to the board, although we also report to the board. And we have to have an analysis. You should have an analysis of the causes of noncompliance, so that you can identify the possible required modifications of the internal controls as a preventive measure going down the road. Isabel, what can you talk about? Let's talk about internal audits, Isabel.
So yeah, that's now what we call the third line of defense. And most places now talk about a fourth line, which is external audit and regulators. But within an organization, the third line of defense is your internal audit function. And the third line of defense is really there to provide assurance to senior management and the board of directors that the first and second line's efforts are effective. Internal auditors need to employ a systematic approach to evaluating and improving the effectiveness of risk management, the control, and the governance processes. Now, the big difference between the third line of defense and the first two is that the third line doesn't own the risks. It's independent, and it has to be independent. The results of the audit can't come back to them in terms of their compensation. Obviously, the organization as a whole has to prosper, but it's really important that they're clearly independent. So there's always going to be a somewhat adversarial relationship between internal audit and the first two lines of defense. And one of the keys here is to not limit the independence of the internal audit, but also create an environment where honest mistakes aren't punished. Obviously, if there's fraud or if there's inappropriate behavior, you have to take a stronger approach. But a lot of times, the adversarial nature between frontline and audit comes into place because any mistake is overly criticized or overly punished. And you have to have some consequences, particularly for someone who makes repeated mistakes. But there also has to be an environment where, if people are working in good faith and doing their best, if there's an honest mistake, let's discover it, let's learn from it, and let's correct it, but not necessarily in a way that punishes the person who committed the mistake, as long as it was done, in good faith.
Which means that the systems under which people operate should not be specifically set up to encourage failure in the work. In other words, the management of the company has to be working in such a way as to encourage success, but discourage dishonesty.
Well, and that going back to Wells Fargo, not to beat up on them, but they're big, they can take it. But one of the things that in the first instance of them of the enforcement action that took place a few years ago, where they were opening client accounts without the customer's permission, one of the problems was that the production goals for the average employee were so high that they couldn't meet them without committing fraud. And so they created an environment where it was almost impossible to do their job without making a mistake. And so I think that's part of not setting people up for failure. Because most people, given the opportunity, want to do well. But like you said, they also need to feel that if they don't do the right thing, they're going to be detected. And I think you can do that in a way where it's not onerous, but it also, creates an environment where people want to do their best.
Okay, that's fair. Should be like that. So COSO sets up 5 components of internal control. The first one is the control environment. That's the standards, the processes, the structures that provide the basis for carrying out internal controls. And it's the implementation of a system of integrity and ethical values of the organization. It includes measuring the competence of the people being asked to do certain jobs, are being required to do certain jobs, and the rigor of performance measurements, meaning the rigor, it's not that you're calling for perfection, because nobody's perfect, but the rigor should be such that it keeps people on their toes, so to speak. It keeps them, as we used to say, chisposo. They have to have sparks. Okay. The second one is the second of these components is risk assessment, and so it's a precondition. So it has a precondition, and that's the establishment of objectives that are linked at different levels of the entity, identifying the risk appetite for the role of the board of directors. Well, this is interesting because this risk assessment and these objectives is similar to a CPM, critical path method, or a PERT chart for construction. Certain things are linked together, and you can't go forward and you can't do it right without every other piece linking up. That works here. And the next thing are the control activities.
Well, let me make one comment on risk assessment, because that's something that we harp on, I think, in every single one of our webinars so far. We've mentioned that. And here, I think the important thing to keep in mind with risk assessment is to make sure that you're measuring all of the risks and looking at them holistically and individually. You need to look in regulatory compliance for financial institutions. You need to look at money laundering risk, tax avoidance risk, anti-corruption risk, all the different risks, OFAC, sanctions compliance risk. You need to look at them individually, but then you also have to look at them holistically, so that when you create a risk measurement for a client or something like that, you've taken into account all of these different risks and not just focus on the big one, which, we all look at, which is the anti-money laundering. So I think making sure the risk of fraud, what types of activities do you have for the risk of fraud? I think all of those need to be looked at holistically.
And so to take a sympathetic approach for a moment, we're talking in this case mostly to bankers, I assume, and bankers are being asked to be policemen. They're being asked to be the guardians of the gate, so to speak. So this is this has been a brave new world for a while, but it's a constant reinforcement of the need for banking personnel to take on a role for which they are not necessarily suited by basic training. It's more like on-the-job training, and if they're not suited to it, then it's something to be considered in where they're placed in an organization, because these controls are paramount for the future and safety of every organization. So what are we talking about with the control activities? That's another one of the activities. So there's information and communication controls. And this basically means that this is the information about the controls to flow within the organization, top to bottom and bottom to top. There has to be a very, almost a frictionless flow of information. If it's not frictionless, then things are going to get lost in the process, and things that could be very important for the organization's future or continued existence. So going back to what was happening with Wells Fargo, there wasn't enough communication, and when there was communication, it wasn't being properly evaluated. Or if it was being properly evaluated, it wasn't. It might have been somewhat ignored. So these are issues.
And I think that the bottom to top is really important. There was a TV show a couple of years ago called Undercover Boss, where the big boss would go into a store, someplace where he wasn't known. He would go incognito and talk to the employees, and would almost always learn that there were things that he thought were really important in terms of controls or to promote sales that just weren't working, but he wasn't getting the feedback from his employees. So I think that it's very important to make sure that not only that the board and the senior management set the tone of compliance and all of that, but they also listen to their staff up and down to find out what stuff really is working and which controls don't make any sense.
I agree. And so one of the things that tends to happen is as people move on in life and they move up the ladder, sometimes they lose sight of what allowed them to move up the ladder, or they lose empathy for the people that haven't moved up the ladder in doing what they're doing or paying attention to what they're saying. And it's important to pay attention. Number 5 is the monitoring activity. So this is the evaluation of the controls themselves, whether this should be ongoing and periodic, because there can be small controls. For example, teller reconciliations daily or for every shift if there's cash involved. But you may need even more, but you may need one overall periodic reconciliation of everything that all the tellers have done. And the same thing would apply to the wire department, would apply to even to the compliance department. So there should be smaller pieces of evaluation and greater pieces of evaluation that take in more information or from a different perspective. And these evaluations should be evaluated against the criteria of regulators. So one of the things that we've discussed in the past is that regulators go to regulator school, and they have a different perspective and point of view. They're not in the business world, whereas bankers are in a business. They're in the business world. And so one of the most important things that COSO will help you with is to keep your regulators happy and calm and less abrasive. Okay. It's natural for everybody to say the regulators are coming and the panic ensues or some kind of nervousness ensues, but that doesn't have to be that way if COSO is being properly implemented. It means that when they come in the door, you're confident that what's going on in your organization will meet their standards. And if there is any kind of failing, it will be so much less of a failing that it won't result, for example, in a financial unnecessary in a financial payment to the government and to the regulators for the failing. It might result in a finding that requires you to do something, but the finding may be very minor compared to what other findings are for other organizations. Go ahead.
I was going to say in terms of dealing with the regulators, when in school, they used to tell you when you were writing an essay, neatness counts. And I think that that's a really important thing to keep in mind when you're developing your control environment. Messy files and procedures that are difficult to locate, anything that suggests a lack of formality. So when regulators come in, if they see that you have your procedures in line, that you have your files are in order, those types of things, that will go a long way towards helping them look at your program as a whole and not trying to find, the one or two places. They're going to try and find where you messed up because that's their job. But if you can demonstrate a really strong control environment that's well managed, well implemented, and for lack of a better word, neat and easy to work with, that's going to go a long way towards keeping them happy.
If you've ever wondered why you could go to a library and find a book among thousands and thousands of books on hundreds and hundreds of bookshelves, the reason is because the library system had something called what we call the Dewey Decimal System. And it was designed to know where every single book is or should be in that library, including those books that have been checked out and borrowed by readers.
Right.
They always knew where to find the book. Okay. What Isabel is talking about is implementing a similar system so that everything can be found in good order.
Exactly. So we're getting to the top of the hour here. Before we finish, I just wanted to let you all know that Foodman has a course that you're going to hear about. We're going to send you some information about it shortly. But the course is on internal controls, and the course is the best practices for effective internal controls. And the topics that we're covering include what are internal controls, what risk areas should be covered, who is responsible for developing them, key processes for developing internal controls, how to measure their effectiveness, and some of the top failures of internal controls. So this course will be available in English and Spanish on our website, on our learning platform, and we're going to be sending you a link in the next week or so so you can access that course. And I think that we're also going to send you a survey on this webinar to see whether you're interested in more information about that course and some of the other courses that we have available. So I don't see any questions from our audience. Hopefully, it's been worth it. Stanley, I don't know if you have any final words you want to say before we finish up the session.
Well, I have this. Internal controls is actually much more than what we've said. It encompasses a lot more than what we've talked about. We only had an hour to speak about it. I highly encourage you to take the course when it's up on our website, because it's going to make you more valuable for your organization. And that generally leads to higher salaries and more advancement. And also the perception of your seriousness or of the seriousness with which you take your position. So I highly encourage it. I think there's a lot more that we could have gone through in this thing because we have a lot more information to impart about all of these things we've discussed, but in much more detail. And if you like this and if you think you'd like to learn more about it, please monitor our website, and Isabel will be sending out or our organization on Isabel's behalf will send out the announcement for the course. This is a labor of love for me, and I strongly suggest that all of you consider taking the course and developing as much information as you can for yourself about how to maintain control and create and operate internal controls.
So before we go, we have a couple of questions on the course, and one of them is asking what the cost is. It's going to be somewhere between $129 and $149 per person, and it's an online platform. So it's not, it doesn't start on a particular day. You can take it and you'll have access to the course for 30 days to complete it online, and you will get a certificate. There was a question whether we're going to get a certificate for this session. I don't know whether we've started sending certificates for webinar participation or not.
Yes, we
I don't
are.
know. We
Yes.
are.
Yes.
Okay, so yes, you will
That
receive a
attended, yes, we do send the certificate.
And then another question, what is the opinion if the team of internal audit takes on the responsibilities of the internal control system certification? That's a question maybe you have an answer to, Stanley?
Well, I think it's a loaded question, actually, because at the moment when they take on the responsibilities for the certification, they're acting in an independent way that a third party outside the organization would normally act. And so their reports are fine. They need to do their reports. They're an absolute requirement. But once they take on the responsibilities of certifying the system of internal control, they're acting as an outside consultant. And there may be they're basically certifying themselves, and I don't think that that's appropriate.
Gotcha. So very good. Then we are now just past the hour. Unless there are any other questions, we thank you again for participating. And Stanley, last words?
No, I think you just said it. Thank you for participating. I thank all 111 people that I saw just now for staying on the line for all of this, and hopefully you really got something out of this. This is going to become more and more important as time goes on. Thank you.
Excellent. All right. Thank you, everyone.
Bye-bye.
Foodman Learning Solutions proporciona las herramientas esenciales para implementar y supervisar su programa de gobierno corporativo. Mediante nuestra plataforma de e-learning, puede acceder a una amplia gama de cursos basadas en las mejores prácticas de la industria en todas las áreas de cumplimiento normativo, incluyendo nuestra certificación profesional en FATCA y CRS que le prepara para la posición de oficial responsable. La Mesa de Ayuda de Foodman es su recurso de cumplimiento en todas las áreas del cumplimiento normativo. Esta herramienta poderosa se puede utilizar para aclarar las regulaciones y recibir capacitación. La Mesa de Ayuda les brinda acceso a una red de especialistas que apoya a cientos de instituciones financieras. Comuníquese con nosotros a través de nuestro sitio web foodmanpa.com o envíenos un correo a info@foodmanpa.com o simplemente llámenos al 305-365-1111. En Foodman la complejidad es nuestra ventaja.